I hope so you all are doing great and my voice is clear and crisp. So let's start with the standard costing chapter through the notes of CA Manan Pujara sir. Okay, they have these summarized concise notes of around 122 pages covering the whole costing. Okay, so let's start. Hello guys, so let's start with the material cost variance. Okay, so example is the 4 units of material FA and 1 unit of B is required to produce finished good F. So A, B, then we can say we get the F. Okay, calculate the all material variances if 10,000 units of F are produced. Okay, and standard rate for A is 2 and B is 10. Okay, so this is the table: standard, revised standard and actual. Okay, so first A, B, quantity 4 1 we are given 4 1. So this is this quantity 4 1 and rate is also given to 10. Okay, so this is also given, we have just copy pasted and then multiplied this quantity into rate, then we got the cost 4 to that 10, and then we got the revised standard quantity, you can say. And this is 10,000 units. Okay, so the quantity is 40,000, like if this is the ratio now, because 4 is to 1, so 4 is to 1 is 40,000 10,000, and rate is 2 into 2 is to 10, same rate that is given here. Okay, so the cost is this multiplied by quantity into rate. Okay, then for actual we get the actual quantity is like actual quantity, I think this might be given in the question. Okay, so the actual quantity is given as 52 and 8,000, and rate is also given as actual. Okay, so the cost actual is this and revised standard is this. Okay, so the material cost variance is standard cost minus actual cost. Standard cost, like the cost that should have been, like this should be the cost. Okay, so but the actual cost that we are getting is 2,12,000. So this is the adverse variance. So this is like a loss for us. Loss, now you can't say the loss because it's not actually a loss, it is just like we are calculating the variance. Okay, so this is the adverse variance, like negative. Okay, then next is material price variance. It is the difference between price. Okay, the price, actual quantity and the difference between price. Okay, so actual quantity for A is 52,000. Okay, and difference between price is 2 and 3. Okay, 2 and 3. Okay, so material price variance for A is 50,000 52,000 adverse, and then for the B it is like 8,000 the actual quantity, and difference between prices 10 and 7. So the actual actual cost is less, so this might come favorable. Okay, because 10 is greater than 7 and also actual is 7 is less than 10. Okay, so this is favorable, and this net is the net of these is 28,000 adverse. Okay, then logic is purchase manager is liable for this variance, because purchase manager is liable because, okay, the duty of purchase manager is to get the required actual quantity at standard rate. Okay, he is not aware nor he can control the actual quantity, hence it is given to him by the production manager, purchase manager, production manager. Okay, so in the given example, it is the duty of purchase manager to get 52,000 units of A at rupees 2 and 8,000 units of B at rupees 10. If you buy that lower rate, it becomes favorable, and if you buy that higher rate than the standard, it becomes adverse. So he is not fully liable because he also bought B for less price, so but he is liable for the A. Okay, this is logic, you can just ignore it, just understand the how this variances are calculated, because this will only be asked in the exam. Okay, this is not of any relevance in the MCQ exam. Okay, this is just logical purpose. Okay, next is material usage variance. Here we will see the difference in quantity, and the price we will take as actual, sorry, actually not actually, price we will be taking as standard. Okay, 2 and 10, 2 and 10, this is given 2 and 10. Okay, so the next is like standard rate. The standard rate we will be taking outside minus the into the standard quantity minus actual quantity. So if the actual quantity is more than the standard quantity, then the variance will be adverse. Okay, so if in this case we will see, so if in this case we see like the actual quantity is 52,000 and 8,000. So 52,000, 8,000, and the standard quantity is 40,000 and 10,000. 40,000, 10,000. So just multiply it by the standard rate, and then you will get the answer. Net is 4,000 adverse. Okay, so logic we are not reading right now because this is not relevant for the examination purpose. You can read from this PDF. This PDF is available, like I will also give it in the description of this video and comment section. Okay, so next is the material yield and total quantity variance or material sub usage variance. Now till now we have studied one material cost variance, second material price variance, third material usage variance, and the fourth is we are studying is material yield variance. So these are the next, like you can see in the chart as well, we have studied these three. Now we are studying yield variance, and next will be material mix variance. Okay, material yield variance is standard quantity in standard proportion minus actual quantity in standard proportion multiplied by standard rate. So just remember that you have to multiply it by standard rate. In the material yield variance as well, and material yield variance and material usage variance, you have to multiply by the standard rate, okay. And here you just take the actual like the quantities that are actually given, but here you will take the standard quantity in standard proportion and actual quantity in standard proportion. So standard quantity in standard proportion is like this only, which we just okay, like 40,000 and 10,000. So 40,000 and 10,000 we just wrote exactly, okay. But the actual quantity total is 60,000. 60,000 in, like, I think this might be in 4:1 ratio. Let me just calculate. So yeah, this comes around to 48,000 and this comes around to, this is given like the 12,000 to 48,000 and 12,000, okay. So this is the actual quantity in standard proportion. So if the actual quantity is the in standard proportion is more, then the variance will be adverse, otherwise it will be favorable. So here the actual quantity in standard proportion is more than the standard quantity in standard proportion, that is the standard quantity that is given in the question. So this will be adverse variance. So the net is 36,000 adverse. So the fifth we are taking is, so fifth is the fifth material mix. We will let's see the alternative also that they were given is total standard quantity minus total actual quantity into average standard rate. So this is the different formula, okay. I have also seen this first time, so let's see what they want to convey through this, okay. So this is the like shortcut to calculate the this net thing. This is not calculating the individual variances, so it is calculating just the total variance, okay, of both the products A and B, okay. So this is like 50,000 minus 60,000. Total standard quantity 50,000, right? 50,000 is standard quantity and actual quantity 60,000, right? So 50,000 minus 60,000, okay, into 18 by 5. 18 by 5, what is it? 18 by 5, it is 18 by 5, okay. Total quantity is 5 and 18 is the cost per unit, you can say. So 18 by 5 is like average standard rate. So just ignore this because this will create confusion. Just remember this thing, like this is logical, just you have to just go through it once and you will get the logic also. So next is the material mix variance. It is like, so here we studied like standard quantity in standard proportion and actual quantity in standard proportion. So here is the somewhat different. Here actual quantity in standard proportion is the first term, and minus we will minus the actual quantity in actual proportion, that is the 52,000 and 8,000 that we were given. It is very easy to understand. So just we have to just take the amount of the the value from the yield variance, like 48,000, 12,000, just put it here and minus the actual quantity that is given in the question, 52 and 8,000, okay. So the answer is 32,000 favorable, okay. So here it indicates error of mix, since actual quantity used is not in the ratio of 4:1 mix variance exists, okay. It simply compares actual quantity only, but in standard ratio versus actual ratio, okay. So okay, so this we are not reading, okay. Next is the labor cost variances, okay. So material variances we are done. Next is the labor cost variances, okay. Here are also 5 types of variances, sorry 6 types, yeah 6 types: labor cost variance, labor rate variance, labor efficiency, labor idle time variance, labor mix variance, and labor yield variance. So in the previous question we saw like material yield, like the value that we get in the like bracket in the second term, the actual quantity in standard proportion that we use in the material. Let's see if the same logic applies in labor variance also, okay. So an example is 4 hours of skilled labor, 4 hours of skilled labor, 1 hour of unskilled labor, 4 hours of skilled labor, 1 hour of unskilled labor is required to produce 1 unit of FG, okay. Calculate all the labor variances if 50,000 hours are required to produce 10,000 units, okay, of F, okay. And SS worked for 52,000 hours and 3 hours was idle time, okay. And sorry, unskilled labor time, skilled labor time is this, and unskilled labor time unskilled labor time worked for 8,000 hours and 2 hours was idle time, okay, got it. Labors are paid for idle time, like the idle time is the paid one, we have to pay for it, okay. So the table is like this: standard you can say for 1 unit, like the standard that is given in the question is 4:1, that is given, like just copy pasted, okay. Then a rate is also given 2:10. Where it is given, I think they haven't mentioned the rate, but they took the rate of the previous question, I think, because previous question it was 2:10, okay. So it will be given in the question, don't worry. 2:10, and so the cost comes to like the same, it is the same as previous question itself, the 18 version, yeah, it is same as previous question. So the revised standard quantity and actual, so sorry, it is not quantity, it is revised, you can say revised standard labor hours. So you can say, like, just remember the revised value, revised standard and actual, okay. So the hours are 40,000 and 10,000, 40,000 and 10,000, okay. Where it is 40,000, okay, wait a second. Okay, so this is revised standard is the like the number of hour that was required 50,000 in the ratio of 4:1. Okay, in the ratio of 4:1, this means to 40,000 10,000. Okay, the rate is also standard rate, that is 2 and 10, and the cost comes around to 1,80,000. Okay, so the working hours now actual we are saying actual working hours, actual idle time, actual total hours, and actual rate and actual cost. Okay, so the actual working hours of 52,000 8,000, that is given 50 to 52 and 8,000. Okay, 52 8. Okay, the 3,000 and 2,000 is the idle time, that is also given 3,000 2,000. Okay, 3 hours for idle time, no? 2 hours for idle time. So they have just taken it in that form, like 3 hours into 10,000. No, wait a second, I think they have given wrongly in the question, so they would have written 3,000 and 2,000. Okay, so that's why the value is 3,000 2,000. So it comes to total around 65,000 total hours, and the cost comes around to 2,35,000. So the standard cost minus actual cost, the difference between these is the 55,000 adverse, that is the labor cost variance. That is similar to material cost variance. Let me just show you that. Material cost variance simply 50,000 minus 1,80,000 minus 2,12,000 was the answer here. Okay, 32,000 adverse. So the labor cost variance is similar, 55,000 adverse. Okay, so the second is the first is this, second is labor rate variance. It is a change in the rate. Okay, so we will first calculate for the skilled labor, then unskilled labor. The skilled labor, the rate change is 2 is 3 2 and 3. Okay, and the skilled is 10 is unskilled is 10 is to 7, 10 into 7. So it is favorable obviously, and it is adverse. Okay, because actual is less now, so that it is favorable. So 55,000 is the total number of wait a second, 50,000 is the 55,000 and 10,000 is the actual hours taken. Okay, we will multiply by actual hours, because we have to see the rate difference, not the hours difference here. Okay, so the third is the labor idle time variance. Idle time is very simple. You just have to take the actual idle hours. The actual idle hours are 3,000 for here, and wait a second. Okay, yeah, the 2,000 is here and 3,000 is here. 3,000 into the standard rate per hour 2, and 2,000 into standard rate per hour, that is 10. Okay, so here we will take standard rate. Okay, idle time variance indicates that laborers are paid wages but no output is produced in that hours. It is always adverse variance. This is the logic, that it is always adverse variance because no output is produced. Okay, so never get confused like what is the answer, what is here. So it is always adverse variance. So the fourth is labor efficiency variance. So here we will take standard rate outside, and difference is the standard hours minus actual hour. It is similar to the material, like the foreign material usage variance, like standard quantity minus actual quantity into standard rate. It is standard hours minus actual hours into standard rate. Okay, so the for skilled labor and unskilled labor, standard rate is 2 is to 10. Sorry, just a second. Yeah, so standard rate is 2 and 10. So and the and the difference between standard hours and actual hours is, standard hours is 40,000 and actual hours is 52,000. Okay, so we have to take actual working hours, not the total hours. Okay, so don't make the mistake here. 40,000, 52,000, and 10,000 and 8,000. Okay, 10,000 and 8,000. Okay, so this is the net answer. Net is 4,000 adverse. Okay, because there are 24,000 adverse and 20,000 favorable, so 4,000 adverse. Okay, so we can also check. Yeah, so the total of these three must be the similar to the labor cost variance. Okay, let's check. Labor rate, efficiency, and idle time. Rate, efficiency, idle time. Efficiency is 4,000 adverse, so put on calculator negative 4,000. So then add 26,000 to it, add 26,000 to it, 26,000, and then just add 25,000. So the answer comes around to 55,000. Okay, so it is verified that we are doing correct. Okay, then next is the labor yield variance. So labor yield variance is the fifth one. Yes, right, fifth variance. Okay, standard hours and standard proportion minus actual hours and standard proportion into standard. It is similar to the material yield variance. Let me just show you again. Yeah, similar to this material yield variance, standard rate multiplied by standard quantity standard proportion minus actual quantity standard. So here is similar standard standard hours and standard proportion that we are already given, that is the 40,000 and 10,000. Okay, 40,000 10,000, and actual hours and standard proportion that we calculated 48,000 and 12,000. 48,000 12,000, this is here. This is not given in the table. This is just we have calculated the 60. We have just did 60,000 in the proportion of 4:1. Let me just show you on the calculator. Like, divided 60,000 divided by 5 is 12,000. So 12,000, this comes down to 12,000. and this comes around to 48,000. Okay, so the answer is net 36,000 adverse. Okay, we are not seeing the alternative because this is not logical, I think. So okay, then next is the labor mix variance. So labor mix variance, we just remember the logic that the value that we are taking here actual in standard proportion, it will be the first value here. Okay, so just remember this simple logic and you will save your time and effort, okay, in the exam. Okay, 48,000 and 10,000, and then the subtract the actual hours that are given in the table, actual hours in the standard proportion, in the actual proportion, sorry, not in the standard proportion, in the actual proportion we will subtract 52,000 and 8,000, 52,000 8,000, and difference comes around to this, and the net is 32,000 favorable. So if you deduct 32,000 minus 36,000, it comes around to 34,000 adverse. So let's see, yeah, 4,000 adverse is this. So 4,000 adverse is the efficiency. So efficiency के नीचे in below efficiency there is mix and yield come, so that total comes around to 4,000 adverse, so hence verified. So this is the end of the labor variance as well and material variance as well. So let's just move to the next portion, that is let's see now we will go to variable overhead and fixed overhead cost variance. Okay, let's just see one hint that sir has written: for multiplication outside brackets always rate should be standard and quantity should be actual. Rate should be standard and quantity should be actual. So, yeah, this is somewhat logic, you can remember if you want to, but I don't think you will make a mistake because we haven't seen this. We have seen, yeah, outside the bracket we have seen actual hours that sir has written, and outside the bracket we have seen the standard rate. Okay, there is nothing else we have seen. So this is a trick. Yeah, it is good trick, you can remember to not make mistake in the exam. Okay, my exam is on tomorrow, right, 2nd July. So I hope so I pass. Okay, so next just move to variable overhead. Variable overhead cost variance, very simple. It is similar to labor cost variance and material cost variance, that is standard cost minus actual cost. Just make sure that you keep the actual cost on the the right hand side, you deduct just keep the right hand side, because it will give you the actual answer, that is the answer is whether adverse or it is favorable. Okay, so okay, then variable overhead expenditure variance, there are only three variants. Okay, first is this, second is this, and third is this. For expenditure variance is, for expenditure we will be changing the rate. So if when we will change the rate, we will keep the something outside na, so actual will be outside, so actual hours, just remember this hint. This hint is very powerful. It will help you to not make any mistake in the standard costing question. Okay, because when rates are inside, so we have to keep the hours outside, because this is the logical na, because you are changing the expenditure, you have to calculate the expenditure variance. So for expenditure variance you have to see what amount of difference is there in the rate. Okay, so rate has to be changed, so in the bracket there has to be rate difference. Okay, so outside there will be hours, so whenever there is outside, the hours will be actual. Okay, so this is logical approach. Okay, so then next is the variable overhead efficiency. So efficiency we will be changing the hours. Okay, so once we will be changing hours, so within bracket there will be hours difference. Okay, then outside there will always be standard rate, outside the bracket there will always be standard rate, and there will always be actual hours. Okay, so the difference is standard hours minus actual hours and into standard rate. This is variable overhead efficiency variance. So next note, what is the note? Let's state number of hours for variable overhead is based on either machine hours or labor hours. Okay, if nothing is given, take labor hours. Okay, also consider labor hours actual worked without considering the idle time. So this is that sir is referring to this, let me just show. Sir is referring to this table. This portion you have to refer only, you have not to consider this idle time while calculating this variance, that is the variable overhead efficiency variance. Okay, just consider the actual hours worked. Actual hours worked in this column of actual hours worked. Okay, so next we will move to fixed overhead cost variance. So there are 5 types of variances. Okay, first is the fixed overhead cost variance, second is expenditure variance, third is volume variance, fourth efficiency, fifth capacity variance. Okay, fixed overhead is somewhat confusing, that I consider in the inter level. Let's see what is the understanding level at the final. Okay, so let's just start with the example itself. Okay, the budget and actuals. Okay, so the budget and actual, the fixed cost is given, budget is this, actual we obviously used more, so this will be adverse variance, so this will be fixed overhead cost variance, I guess. Let's see, fixed overhead cost variance. Okay, yeah, this is the 2,80,000 adverse. Okay, first 14 lakh minus 16,80,000 is equal to 2,80,000 adverse. I don't know why it is written so big, it was very obvious na. from this, like budgeted minus actual. Wait, sorry, just ignore this thing I just told it. Let's just start from here itself. Units produced are given, hours, working days. No need to revise standards as per actuals, since fixed cost doesn't change per unit basis like variable cost. Sir is saying that we don't need to make this column, like this column was this is not needed here. That is the revised standard as per actual. Okay, this is not needed. Okay, sorry, again I'm confusing. This thing is not required. That is the actual hours and standard proportion is not required here, because fixed cost doesn't change, because like fixed cost doesn't change per unit basis like variable cost. Okay, this is the simple logic. Sorry for making some silly mistake by me. Okay, just ignore it. Okay, then first is overhead absorption rate per unit, that you have to calculate. This is the like for you have to remember this, because if you go into logic of fixed cost variance, you will get somewhat confused. Even I get somewhat confused, so I won't go in the logics. Just remember overhead absorption rate per unit. So it is like 15 lakh, that is the budgeted, divided by 7500, that is the budgeted units produced. Okay, that we budgeted that we will produce. Okay, so it is 200 per unit. Okay, next is the overhead absorption rate per hour. Okay, absorption rate is like 15 lakhs, that is the budgeted fixed cost divided by the hours. That simple, it is similar, like it was per unit, it was per hours. Okay, so it is simple, it is similar to this, both are similar. Okay, then next is overhead absorption rate per day. It is also similar, I guess. Yeah, 15 lakh divided by 25, it is just the difference between the units that we are using. Okay, then next is budgeted hours per day. Budgeted hours is like 30,000 divided by 25. It is like this is just the interpretation of the table. We are just calculating the table values. Okay, then next is the budgeted hour per unit. That is 30,000 divided by 7,500. That name is clearly showing what you have to calculate. Just you have to remember the names, like, because it will help you, like it will simplify your way of solving the question in the exam. It will save your time and effort. Okay, so I just had to remember that overhead that I was calculating is the I got just remember that fixed over expenditure variance is the what I was calculating the difference between these both. Okay, 15 lakh and 60 lakh 80,000. This is the 1 lakh 80,000. It is the fixed overhead expenditure variance that I was remembering, that I was referring to as the fixed cost variance, but it is not cost, it is the expenditure variance. I just like it just clicked into my mind. Okay, so let's start with the fixed cost variance. So fixed cost variance is absorbed overhead minus actual overhead. Okay, so absorbed overhead minus actual overhead. Absorbed overhead is like we have to take the absorbed overhead per unit. Okay, actual overhead. Okay, so sorry, I don't know why I got confused a bit. It is very simple, like you have just calculated the rate of absorption 200, so you just multiply it by the actual units produced, 7,000 into 200, that is 14 lakhs. Okay, and minus the actual fixed overhead, that is the 1680,000. The answer comes around 2 lakh 80,000 adverse. Okay, so next is expenditure, that I already explained, that is the budgeted fixed overhead minus the actual fixed overhead. Okay, so this is the difference. Okay, then next is fixed overhead volume variance. Here we will change the quantity, that is actual unit minus budgeted unit. Actual unit 7,000 minus 7,500 into the overhead absorption rate per unit that we calculated. Okay, so the calculation earlier makes the whole difference, like it just makes the process easy. Okay, the answer is 1 lakh. Okay, so this is just the verification that you will see in the chart, like expenditure plus volume is equal to overhead cost. Expenditure plus volume 1 lakh 80,000 plus 1 lakh is equal to 2 lakh 80,000. So hence verified. Next is the fixed overhead efficiency variance. Okay, so next is the fixed overhead efficiency variance. Here we will calculate the standard units in actual hours and actual units in actual hours. Okay, into the overhead absorption rate per unit. Okay, this is the 200 that we calculated earlier. Okay, we are using this similar in the every formula almost. Okay, so the next is the standard units in actual hours. Standard units in standard units is actual hours. Okay, wait a second. So hello guys, let's continue from this again, because I just paused the video. So just let's continue. So this is very simple, like just see this logic that sir has given. It measures speed of work. If less units due to less speed, then adverse, otherwise favorable. So here we will see, like we have the budgeted hour per unit, right? 4 hours per unit wise our budgeted rate. So how many hours we actually work? We worked for 21,000 hours. So 21,000 divided by 4 will give us the figure of 5250. Okay, 5250 is the, like this should have been based upon the like what have we budgeted. Okay, so based upon the actual hours, this should have been the standard units in actual hours. This should have been the standard units in actual hours minus the actual units in actual hour, that is 7,000 given in the question. So this is like very favorable, because actual units we have produced so much in the actual hours, then we have budgeted for the same. Okay, so you can also understand through this way. Okay, so next is the fixed overhead capacity variance. It measures the hours worked. Here we have to work for 30,000 hours, but we worked for 21,000 hours. So this is adverse, because we worked for less hours. We were supposed to work for this number of time, but we worked for less number of hours. 30,000 and 21,000. 30,000, 21,000. So difference is 9,000. 9,000 into overhead absorption rate. Sorry, into overhead absorption rate per hour that we calculated earlier, that is 50 per hour. Okay, so this is the fixed overhead capacity variance for like 50,000 adverse. Okay, so now we also check through the chart that you can check just for verifying. Okay, the next is fixed overhead calendar variance. So it measures number of days worked. Here we have to work for 25 days, but we worked for 21 days only, so it is also adverse. Okay, so 21 minus 20, 21 minus 25, 21 minus 25, wait a second, 25 minus 25, why they did like actual minus budgeted? Okay, so that the answer is negative, right? Okay, so you just, even if you don't do this like now, even if you do budgeted minus actual, the answer will be same, because you understand the logic now, because the actual is less, but budgeted was 25 days, that we were supposed to work for 25 days, but we worked for 21 only. So this is adverse now, this is logic now. You have to understand the question, then you can't get the answer wrong. Okay, because ICA will give 2,40,000 favorable, 2,40,000 adverse, the both options will be given if for example. Okay, so you just have to clear your logic, then your answer can't be wrong. Okay, when we calculate calendar variance, capacity variance changes based on days. Fixed overhead revised capacity variance. Okay, in 21 days working hours should be 25,200, that is 1200 into 21, 1200 into 21, 1200 into 21, that is based upon this 1200 hours, that is budgeted hours per day, into number of days worked, that is 21. So by multiplying we get the value is 25,200. so the difference is like standard should be this, standard is this, like this is standard, this is actual, so this is adverse answer will come. Okay, so not if budgeted units and actual units are same, then fixed overhead volume variance will be 0, because obviously there is no difference in volume. So if you multiply by the difference, that is 0, multiply anything, that answer will be 0 na? Still it will be further analyzed into capacity variance and efficiency variance to check error in speed or hours worked. Okay, but net answer will be 0. For example, say if this is 2,10,000 adverse, the other will be 2,10,000 favorable, and the answer will be 0, because the volume variance will be 0 in that case. Okay, so this ends our fixed overhead variance. So guys, we are back. इसको फिलहाल सेल्स वेरियंस को छोड़ रहे हैं, बिकॉज एक चीज़ समझ नहीं आई ये वाली, तो फिलहाल अब छोड़ रहे हैं, इसको नीचे बस पढ़ लेते हैं. ठीक है, सेल्स प्राइस वेरियंस, सेल्स कंट्रीब्यूशन वेरियंस, सेल्स मार्जिन वेरियंस, मार्जिन प्राइस वेरियंस. Because standard costing is constant, hence only impact on contribution or profit is due to selling price. Okay, and sales quantity variance is further analyzed into two parts, that is market size variance and market share variance, which is discussed later. Okay, in sales variance we consider selling price and standard cost only, hence no change of cost due to actual quantity, thus no requirement of calculating revised standard as per actuals that we calculated in material variance and the labor variance, right? You remember. Okay, then all calculations are above are important for understanding purpose only, because covered in IPCC. The topics discussed below are now important for exams than basic calculation of variances. Okay, let's move forward. Like first is the planning and operational variances. Okay, when current environment conditions are different from anticipated environment conditions prevailing at time of setting standard or plans, use of routine analysis for variance for measuring managerial performance is not desirable or suitable. Thus, to measure managerial performance with reference to material, labor and sales variances, it is necessary to compute planning and operational variances. Okay, the planning variance simply compares the revised standard to the original standard, and operational variance simply compares the actual results against the revised amount. Okay, then an example is given as original standard, revised standard and actual standard. Actual is given. Okay, like we calculated in the labor and cost variances, labor and material variances. Then first is given as original standard, that is 4,500 units at 2 kgs requirement at 12.5 rupees. Okay, and total cost comes around to 112500. Okay, and a revised standard is 4,500 into 2.25 kgs into cost 11.5. Okay, it comes through 116437.5, and the actual is for 87,500 kgs required into 8750 kgs into 13. Okay, they have directly given the kgs. Okay, 4500, like they have just did like this, 48750 4500, this value is multiplied by 4500, then they're multiplied by 13. The answer is 4113,750. Okay, so the first is traditional variance, that like this is a comparison kind of chart. Okay, the understanding purpose only. Traditional variance is material cost variance. We will just do what 11250 and 11350, 113,750, then we will calculate this. Okay, material price we will calculate like this: actual quantity 8750 into 12.5 minus 13 minus 12.5 minus 13. The answer is 4375 adverse. And material usage, this is like what we have learned in the previous few minutes. Okay, material usage is standard rate into standard quantity minus actual cost. 9000 minus 9000, that is 9000 is 4500 into 2, 9000 in minus 8750 into 12.5, that is the standard rate 12.5. Okay, so then planning variance is material cost variance is equal to standard costing in standard cost minus actual cost. Standard cost is this, that is 11250 500 minus the actual cost, like as per the revised standards. Okay, 116437. Then material price is the actual quantity will be outside, and there will be standard minus actual rate 12.5 minus 11.5. Okay, then the multiplied by actual quantity, that is 125, that is 4500 into 2.25, it is the actual quantity in kgs. Okay, then material usage we will be like the difference between standard quantity and actual quantity and multiplied by standard rate. Okay, so the answer comes down to 14062.5. Okay, and then operational variance is material cost variance, standard cost minus actual cost, it is like 116437. Standard cost as like this is the revised standard cost. Okay, this is the original standard, this is the revised standard. Okay, minus the actual cost, 113750. Okay, then material price variance, actual quantity will be outside, that is 8750. Here we took the actual quantity, that is the revised actual, like the revised standards you can say. Okay, then in the planning variance, in the operational we are taking the actual, in the planning we were taking, because with the planning we will standard, we are taking the revised standards. Okay, operational we are taking the actual quantity 8750 and standard rate minus actual rate, this is the revised standard rate you can say. Okay, this is the actual rate. Okay, 11.5 minus 13, 11.5 is this standard. Okay, minus 13. Okay, so this, you just have to remember, like we are not comparing in operational like this we are not comparing this, because this we have done in traditional variance. Okay, we are comparing the revised standard with the actual in this operational variance, and in the planning variance we were doing like this. Okay, right, we were doing like this only, yeah. In the planning we are doing original and revised comparison, and in the operational we are doing actual and revised comparison. Okay, so the material usage variance, that is standard rate will be the 11.5 rate, that is the revised standard rate into standard quantity, with that will be 4500 into 2.25, that is that comes to 10112 into 10125 minus actual quantity, that is 8750. Okay, then this is just verification purpose, you can check it. Okay, overall check this simple 1250 adverse. Okay, planning and operation variances with respect to material and usage variance will not be reconciled with the traditional variance, because actual quantity and standard rate used outside brackets to multiply are different, because actually that we have seen because actual quantity is different here, it is different. Okay, so for reconciliation we must use same actual quantity and original standard rate. Okay, this we all logically know, right? Then planning variance is further analyzed into controllable and uncontrollable variance. Uncontrollable is due to the inefficiency of the cost center, and uncontrollable is due to the factors beyond the control of the management. Okay, then generally planning variance is uncontrollable, however failure in anticipation of market trend leads to fault in setting standards, and this can be argued with controllable planning variance. Okay, example is given: a firm can either use product PG or PD. It decided to use PG. Okay, so the current price of PG is this 2.5 and PD is also 2.5. Anticipated price is also 1.5 after 3 months of both. The actual price after 3 months is 2.25 for this and 2 for this, but firm purchase the 2.7. so let's analyze why the difference is there. Okay, traditional variance is equal to 1.5 minus 2.7, that is 1.5 minus 2.7, that is the traditional variance. Okay, and operational variance is the revised, that is 2.25, actual, that is revised, you can say that. Okay, minus the actual 2.7, that we already seen in the above table, like how to calculate the operational variance. That operational you have to calculate like the actual, you have to take the actual figures. Okay, and the revised figures. Okay, and for the planning variance you have to take the revised figures as well as the original figures. Okay, Then had firm estimated perfectly among the PG and PD, it would have chosen PD at rupees 2. Hence planning variance can be divided in as uncontrollable planning variance, that is 1.5 minus 2. Okay, that is uncontrollable because this you can't control. Okay, you have anticipated but the price actual was 2 after the 3 months. Okay, so this is like uncontrollable, and but controllable is like 2 and 2 and 2.25. Okay, this was controllable because if you have chosen the PD product na, so you would have reduced your like actual price. Yeah, would have to purchase after 2 if you have chosen the PD product, but you choose the PG product. Okay, so this is a loss for you. Like this is the controllable planning variance. Okay, so next is the market size variance. Okay, market size variance first was like we studied like the planning variance and operational variance. Now market size variance and market share variance. It is similar to, like they have written that it is similar to planning variance, it is similar to operation variance. Okay, then market size, total number of units that can be sold in the market, that is total addressable market in quantity. Okay, then is the market share out of total units sold, that is market size, how much units our company sold. Okay, this is like the calculate the market share. Like this is logical, very logical terms, these are very logical terms. Market size is the total addressable market, then market share is the like how much share like the Airtel is having between the telecom sector. Okay, you can say that. Then market size variance and market share variance, market size and market share. Okay, difference in market size multiplied by budgeted market share percentage into selling price or cost price per unit or net profit per unit. Okay, and market share variance is difference in market share multiplied by actual market size into selling price or cost per unit or net profit per unit. Okay, so let's see how they have calculated this. Market share is given at 10,000 20,000 units, budgeted is this and actual is this. Market share is 20% they have budgeted, but actually the market share came to 15% and units sold were 2000 budgeted and actual were to 3000 and selling price budgeted 5 and actual is also 5. Total sales 10,000 and 15,000. Okay, so the market size variance is equal to the actual industry size. This is the difference between 20,000 and 10,000. This we have to calculate like actual minus budget, because this is like the positive kind of variance, you can say that it is from the sales point of view perspective na. So if the actual is less, so the answer will be adverse. Okay, so if the actual is more, the answer will be favorable. Okay, so difference between these multiplied by the budgeted market share. Okay, that is written here also, multiplied by budgeted market share multiplied by the selling price per unit, that is whatever is given you have to multiply it by, because the selling price is given, so selling price per unit we will multiply it by this, then we will get the answer as market size variance 10,000 favorable. Okay, then market share variance, market share is like you have to calculate like the total actual market share percentage is 15%, then minus budgeted 20% into the multiplied by actual market size is 20,000. Okay, 20,000 multiplied by selling price per unit. So this is simple, like this is like a reciprocal kind of thing, you can just logically get the answer, because actual minus budgeted, this is logical, this you can't get wrong. Okay, multiplied the market share, because obviously then you will get the market size na, then market size will be you will get by multiplying the market share na, and market share you will get by multiplying the actual industry sales quantity. Okay, so this is the actual industrial sale. Okay, then note, if we are asked to calculate based on the contribution or net profit, then instead of selling price multiply by this is not cost per unit, this is contribution per unit. I by mistake spoke cost per unit. Okay, then interdependence between variances. Okay, let's see how much of this theory is left of variance analysis. Okay, I guess there are like various pages left. Then let's read quickly. Interdependence between variances. Use of cheaper material which is of poor quality, because this is important to understand. Okay, use of cheaper material which is of poorer quality, the material price variance will be favorable, obviously, because we will use the like sasta material na, but this can cause more wastage of material leading to adverse usage variance. Okay, then using of more skilled labor to do the work will result in an advanced labor rate, because we have to pay more na, because if we use skilled but productivity will be higher as a result due to experienced labor, hence favorable efficiency variance. Cheaper material and labor, poor quality material, etc. is used to cater the larger public in the market. Okay, then changing the composition of a team might result in cheaper labor mix, favorable mix variance but lower productivity, adverse yield variance. Okay, this is logic, this is pure logic, just you have to you can read this again. Okay, then workers trying to improve the productivity, favorable efficiency variance, because they are trying to improve the productivity but in order to get the bonus, but this will mean that labor rate variance might get adverse. Okay, use materials wastefully. Okay, they might get labor rate variance is also adverse, and labor material variance will also get adverse. Okay, sorry, what I am saying, sorry, material usage variance will also get adverse. Okay, current sale price adverse sale price variance, okay, might result in higher sales demand from the customers. Favorable sales variance, okay, this is somewhat confusing. Okay, similarly favorable sales price variance may result in adverse sales volume variance. Okay, obviously this can happen. Okay, this is logical. Okay, interpretation of it, this is the most important. Like this can be tested in your MCQs. Okay, in our MCQs, sorry. There can be number of potential causes leading to variances in the operational cost. Okay, first being the material price variance might be caused due to the use of different supplier. Order size can result in variance. Any form of unexpected increase in buying cost, such as higher delivery charges, efficiency or inefficiency associated with the buying procedure adopted. Okay, lack of appropriate inventory control can result in emergency purchases of material, resulting in adverse variance. I think this sir has copied from the ISA material itself, so let me just go to the ISA material and let's interpret there. Okay, so this is given as this. In the IC material, there can be number of potential causes leading to variances in the operational cost. First, if we study about material price variance, reason of this is that it might be caused due to the use of a different supplier. Okay, order size can result in variance, right? Any form of unexpected increase in buying costs, such as higher delivery charges, can cause this variance. Okay, yeah, right, because price will get increased, na. And then inefficiency or inefficiency associated with the buying procedure adopted, bilkul rightly said. And lack of appropriate inventory control can result in emergency purchase of material, resulting in adverse variance, because you have to purchase at high cost, right? Then material usage variance, purchase of inferior quality material, right? Then because of you will use more material, na. Standard you have planned that you will use 15 material, but if you use like inferior quality material, like your material will be easily destroyed or deteriorated, so you have to buy more material, so you ended up using around 80 quantity. Okay, so this is like the adverse, na. Okay, and then implementation of better quality control. Okay, this can also, yeah. Then increased efficiency in production can help in bringing down wastage rate, because rightly said. And changes made in the material mix, careless way of handling material by production department, and change in method of production or design, and pilferage of material from the production department. Okay, then poor inspection, yeah, this can also relate. So everything that is related to the material, na. So you can material or the quantity, the stock in the organization, so you can directly say that this is the reason of material usage variance. Then labor rate variance, unexpected increase in the pay rate of labor, level of experiences of the labor can impact the direct cost of labor, right? And payment of bonuses added to the bilkul. Then change in the composition of the workforce can impact direct labor cost. Okay, and labor efficiency variance, improvement in work or productivity efficiency, workforce mix can have an impact upon labor efficiency levels. And then industrial action in relation to workforce, then poor supervision of the workforce. Then learning curve effect, these are all the like the reason interpretation of the efficiency variance. Let's read again. Improvement in work or productivity, right? Then workforce mix can have an impact upon labor efficiency levels, right? Then industrial action in relation to workforce, then poor supervision of the workforce. Okay, right? And learning curve effect upon the labor efficiency levels, right? And then resource shortages causing an unexpected delay and lowering of labor efficiency levels. Then using inferior quality of material, then introduction of new machinery resulting in improvement of labor productivity levels. Okay, then overhead variance, fixed overhead expenditure variance are caused by spending in excess of the budget, right? This that I was referring to in the video in the previous few minutes, that I got also confused. Okay, then fixed overhead volume variance is caused by changes in production volume. Okay, then variable overhead expenditure variance are often caused by changes in machine running costs. Okay, then variable overhead efficiency variance causes are similar to those for a direct labor efficiency variance. Okay, direct labor efficiency variance. Okay, then sales price variance, higher discounts given to customers in order to encourage bulk purchases, the effect of low price offers during a marketing campaign. Obviously in these cases you have to lower your selling price, thereby making your sales price variance adverse. Then poor performance by sales personnel, or it can also like increase your it can also be favorable in some cases, because if you sell a large amount of quantity, then it can also be somewhat favorable. Okay, then market conditions or economic conditions forcing changes in price across the country. Okay, sales volume variance, successful or unsuccessful direct selling efforts, successful or unsuccessful marketing effort, for example the effects of an advertising campaign, then unexpected changes in customer preferences and buying patterns, then failure to satisfy demand due to production difficulties, then higher demand due to a cut in selling prices or lower demand due to an increase in sales prices. Okay, so these are the basically reasons, like the interpretation of the variances. So now we are back again in this PDF. Okay, so the topic next is the investigation of the variances. Okay, factors to be considered when investigating the variance: size, type of variance, cost, pattern in variance, budgetary process. First, small variances below certain limit should be ignored and not investigated. This is like the materiality level in the audit. Okay, the type of variance: adverse variance is given more importance, right? This is logical. Cost of investigation should be lower than benefits derived from it. This is logical. Pattern in variance: if particular variance is continuously worsening over time, then when investigation needs to be undertaken. This is also right. Then budgetary process: in case the budgetary process is uncontrollable. Okay, then unrealistic, then instead of investigating variances, budgetary process should be reevaluated. Okay, then methods that are used for evaluating the investigating the variances: first is simple rule of thumb model, second is statistical decision model. So first, what does this simple rule of thumb model say? If variance is greater than certain amount or above certain percentage of total cost, then it must be investigated. This is like a simple rule of thumb, like this is the written fact that if the variance is below above certain percentage or certain amount, then it must be sincerely investigated. Okay, second is statistical decision model. In this model there can be two outcomes: variances can be in control due to random fluctuations around the expected outcome, like the COVID-19 you can say, or it can be out of control. Here company should be more concerned and corrective action can be taken to rectify the situation. Okay, then using normal distribution theory, probabilities of variances being out of control is calculated. Okay, normal distribution you would have studied in the AFM. Okay, then next is the reconciliation of profits. In order to reconcile the profit, we need to reconcile all the variations, that is material overhead, labor overhead, variable overhead, fixed overhead, sales variance. Sales material, labor and variable overhead changes on per unit basis. We revise standards based on actuals. Okay, for fixed overhead and sales variances, we just compare budgeted versus actual. Hence, to reconcile the profits, we need to combine above two processes. Okay, they have given the table. We need to reconcile standard profit of 300 and versus actual profit of 660. Okay, for which we have to calculate all possible variances. Okay, using column 2 and 3, revised standard versus actuals. Okay, the material cost variance is equal to standard cost minus actual cost, labor cost variance not available, variable cost variance. Okay, for above variances there is no breakup of usage, volume, how much material, labor used is given, hence directly cost variance calculated. Fixed overhead also calculated, then sales price also calculated. Then since quantities of revised actual are same, we do not calculate volume variance. Okay, then net reconciliation is equal to 60 adverse plus 120 adverse plus 100 adverse plus 480 favorable is equal to 200 favorable. Okay, this is 60, 120, 100, 480. Okay, then what is next? Using column 1 and 2, standard versus revised. Since we are comparing budgeted versus revised, we never calculate material, labor and variable overhead variances. See, in column 1 and 2, all variances are reconciled except the contribution variances. There are two approaches to reconcile. Volume variance are calculated as quantities are different. Okay, the approach 1 is marginal costing approach. Approach 2 is absorption costing approach. Okay, budgeted contribution 800 budgeted contribution is this given. Okay, budgeted and the 960 is a revised contribution. Then revised contribution 960 is directly reconciled. How? This is reconciled by this, that is, since contribution volume variance is sales contribution volume variance is equal to actual quantity minus standard quantity into standard contribution per unit, that is 100 minus 120. 100 minus 120 is like from where they 100 minus 120, 100 minus 120 into the contribution per unit, that is 8. Okay, that is 8 is equal to 160 favorable. So this is reconciled perfectly, because 800 plus 160, 800 plus 160 is equal to 960. Okay, this is reconciled. The next is the absorption costing approach. In absorption costing, we calculate the fixed cost per unit basis, hence we reconcile contribution directly by reconciling fixed cost plus profit. Okay, then fixed overhead volume variance, we calculate like absorb fixed overhead, okay, minus the budgeted fixed overhead. How we calculate it? Actual units minus budgeted unit, that is 120 minus 100, that we also seen here, into overhead absorption rate per unit, that is given as 5. That is overhead absorption rate per unit that is given at 5. How they calculated 5? Let's see. Okay, so overhead absorption rate they have calculated like per unit, you can say, is like 500 is the total fixed cost divided by the number of units, that is the budgeted units, is equal to overhead absorption rate, that is 5. Okay, so they have calculated like this. Okay, into 5 we multiplied 5 into the absorbed fixed overhead minus budgeted fixed overhead, that is 120 minus 100, 120 minus 100. Sorry, I just referred this in this earlier. Okay, but this is the same figure, so this creates some confusion. Sorry, overhead is this. Why am I confusing? Wait a second. I don't know why I got confused. It is units only. So, okay, the units difference into the overhead absorption rate. Okay, please ignore my silliness. Just move forward. Stay positive. Then sales margin volume variance equal net in actual quantity minus standard quantity into standard net profit per unit. Let's see, actual quantity minus standard quantity. Actual quantity is this minus standard quantity. Actual quantity minus 120 minus 100. This is 120 minus 100, right? Into standard net profit per unit. Standard net profit per unit is 3. 3 is given. Okay, yeah, 3 is 60 favorable. Okay, so net reconciliation 100 favorable plus 60 favorable is equal to 160 favorable. So final reconciliation 360. Then various analysis in activity based costing. So guys, we are studying these last two concepts, that is variance analysis in ABC and relevant cost approach, and after that there are like given miscellaneous concept. This you can read on your own because these are not like thing much relevant, so you can read on your own. Okay, and the next is learning curve theory, that also you can read on your own, or you can watch some video, because I have also need to watch, so I can't explain if I haven't even watched. Okay, so this is the last two topics that we are reading right now. Okay, so let's start. ABC approach is based on assumption that overhead is basically variable. Okay, but variable with delivery numbers and not units output. Okay, hence consider every activity as variable overhead and compute variable overhead variances. So for example, n is a multiple product manufacturer and produces unit, and all overhead are associated with delivery of unit to the customers. Calculate efficiency variance, expenditure variance by adopting ABC approach. Step 1 is to determine the actual output. Step 2 is to determine the revised standard as per actuals. Step 3 is compared revised standard, compare these two. Okay, simple. Hence here instead of quantity we use activity for actual calculation. So for calculations, okay, then first is the given overhead is given, output is customer deliveries. Okay, solution is standard is 2000, right? Standard is 2000 budget. Okay, then revised standard is like 2100 is the revised standard, and actual is also 2100. Okay, and then delivery is 20, rate is 200. 200 is calculated how? Like I guess this has been calculated by, like this is given, this is not calculated, this is given, I think. They have not given in the question, but yeah, this is must be given. And cost is 4000. And delivery 21, 21 delivery how? This is based on this. If for wait a second, yeah, this is like standard for actual na. So standard for actual is equal to 20. If that, sorry, yeah, if 20 by 20 is for 2000, then how much for like for 2100, you can say. So the answer should be like this: 212. This is like 212, like yeah, 21 is the answer. 21 is the answer. Okay, I am a bit confused here. Not confused, I got bit like I am not clear. Okay, expenditure variance is equal to standard minus actual rate, then into actual quantity or delivery. Here we will use delivery. Okay, 200 minus, wait a second, what they have done, wait a second, 200 is the standard rate and actual rate is 3900 by 19. Okay, they haven't taken the fraction. Okay, rate is 3900 by 19. Okay, so here they calculated the rate by like overhead by this 4000 by 220. Okay, 4000 by 20 is 200. Okay, they calculated like this only. So they have just taken that same tarika, same way in here, 200 minus like the actual rate into the deliveries, that is the actual delivery. Okay, because we understood na, like this was the hint given by sir in the previous pages, that when you multiply by the quantity it has to be actual, because within the bracket you are like taking the difference of the rates. Okay, so actual quantity is 19, deliveries we have to take here because this is the way of ABC costing. Then answer is 100 adverse. Cost is कितना खर्चा होना चाहिए as per actual activity, or cost impact of paying more or less than standard for the actual activities undertaken. Difference in rate into actual activity. Then efficiency variance is equal to standard quantity minus actual quantity into standard rate.
that is standard quantity minus actual is equal to 21 minus 19. Okay, standard, that is the revised standard quantity. Okay, into 200, that is the standard rate, that is given here. Okay, the answer is 400 favorable. कितने deliveries या activities होनी चाहिए as per actual output? This is somewhat like logic given in the bracket, you can read if you want. Okay, then hence variable overhead cost variance is equal to standard cost minus actual cost, that is 4200 minus 3900. Okay, it is 300 favorable. Okay, so the next is relevant cost approach. Relevant cost approach is used if inputs are limited. Failure to use limited inputs nearly properly leads to not only to increased acquisition cost but also to loss contribution. Therefore, it is necessary to consider the loss contribution in various analysis. When this approach is used, price or expenditure variance are not affected. Okay. Here, for example, standard units is 1000. One unit require 2 kgs at rupees 10 per kg. Okay. Total raw material available equal to 2000. Okay. So the actual units produced is equal to 800. But standard was this, like, because this is calculated like this, 2000 by 2 is equal to 1000 kgs, 1000 units, sorry. Okay, because one unit require 2 kgs, na. So this is simply cross multiplication. And actual material used is 1800 kgs. Actual unit produced this, actual material used 1800. So if we take by this, like 1800 by 2, if we take, then we must have produced 900, but we have produced 1800. So the 900 was the target. Okay, contribution per unit is 50. Calculate the material usage variance and sales contribution volume variance using traditional approach and relevant costing approach. So the standard is like we calculated like this. This is the 1600. Wait a second, how did they calculate the revised standard quantity? They calculated, I think, by this like the 2000 for 1000 units. Then how much for 800 units is equal to, this is for this, like, so this is 1600 kgs. Okay, so I think the 900 is nothing, I wasted my time. Okay, so the 2000 kgs is the standard quantity and revised standard quantity is 1600, actual is 1800, that is given in the question. So using the traditional approach, material usage variance will be standard rate is 10. Okay, multiplied by the difference between quantities 1600 and 1800. Okay, 1600 1800. Okay, so the answer is 2000 adverse. So the sales volume contribution variance is equal to actual sales quantity minus standard sales quantity, that is 800. It is not 800, I guess it is 1800. 1800 should be 800, na. Yeah, or wait a second, they have taken the units. Okay, 800 units minus 800 units minus 1000 units. Okay, they have taken the units. Okay, into 50 is equal to 10,000 adverse. Relevant costing approach. Since the company have limited raw material, it should have been used efficiently. In order to calculate variances, we need to calculate loss contribution, which can be calculated as follows. Step 1 is which resources are limited and how much is, which resources is limited and how much it's actually used. It is 1800 kgs use, that is given here. Okay, 1800 kgs. Okay, the next is the step 2, in actual use of scarce resources, how many units can be produced. 1800 by 2, we, yeah, this is 900, I didn't actually waste my time, so this is 900 units. Okay, and had 1800 kgs used effectively, 900 units could be produced, but we produced only 800, that is we wasted like 100, like we wasted worth 100 units worth of raw material, that counts to around 200 kgs also. Okay, then step 3 is excess usage of 200 kgs led to loss of production of 100 units, thus loss contribution is equal to 900 minus 800 into 50. 50 is the contribution per unit, that is given in the question itself, you can see here. Okay, then 5000 rupees is the loss contribution. It is not function of sales manager to use material effectively, hence loss contribution of 5000 will be excluded from the sales contribution variance and added to material usage variance. Okay, so the material usage variance will be 7000 adverse and sales volume contribution variance will be 5000 adverse, that is subtracted by 5000. Okay, important note is for sales volume variance, always use marginal costing approach, sales variance. Okay, and not absorption costing approach in sums of relevant costing, because fixed overhead cannot be on per unit basis. This is logical thing. If you can remember, then please remember it. All the best. Then we are now discussing these, you can discuss this, just discuss this different thing, and McDonaldization, breaking tasks into smallest possible units and rationalizing them to find a single most efficient method for completing each task. All other tasks are discarded. Standards can be more accurately set and assessed, helpful in services like hairdressing, dentistry, optician services. Okay, so then there is a learning curve theory. Okay, so you can read it and this chapter then ends. Okay, so guys, all the best, guys, bye bye, stay tuned. And yeah, like the video, share the video and subscribe the channel. Bye.